Okay, in this video we're going to start with another simple financial planning example. We're just going to change a couple of the assumptions in the last model we did and look at the implications for our firm, for the financial statements, the income statement, and the balance sheet. So the two assumptions we're going to tweak here are the pre-tax costs. Instead of being 83% in the previous iteration, we're going to drop that to 71%, so the firm is more profitable. And instead of the firm paying out 60% of net income as dividends, we're going to change that to be 30%. So they're retaining more income, more of the retained earnings, and plowing that back into the firm's equity. So let's go take a look at the spreadsheet and see these changes. If we go down here to the bottom part of the spreadsheet, this first tab, we can see the changes. So the income statement, the only thing that's changing here, well, we got the same sales. We've now dropped the cost to be 71%, so our pre-tax income is higher. The tax rate is remaining the same at 21%, so we've got a much higher net income. We also are paying out less percentage-wise in dividends. We're only paying out $400 in dividends, $412. So that means that we've got $962 in retained earnings, and you can see that that flows down here to our balance sheet. We've got an increase in equity of $962, and that's going to have some implications here in a minute. Nothing has really changed as far as the balance sheet goes. We've still got an increase, a 20% increase in current assets, a 20% increase in fixed assets. So our overall increase in assets, again, is 20%. We're assuming we're at full capacity, so a 20% change in sales implies a 20% increase in assets that we'll need to increase assets that much. And so now, again, we need to have a balance sheet that balances. So we go over here, we do the same process that we did last time. The current liabilities are increasing by 20%. Long-term debt, we're going to march that across just as it was before, again, as a first cut. So the total liabilities is now at $2,600. The equity is going to be the equity from last time. Add in the retained earnings from this year's projection. And we've got total equity of $2,962. That gives us total debt and equity of $5,562. So it turns out actually that right now we have a surplus of financing. We have a surplus of liabilities and equity. And this number here, it tells us that we've got $162 too much. If you look over at the $5,562 and the $5,400, we've got $162 too much of financing. And so again, there's a wide variety of what you could do. You could either pay down debt. That's what we're going to do here. Use debt as the plug. We could also return to equity. We could have this year a bigger dividend than the 30% dividend, the 30% payout ratio. We could change that by $162. And maybe we'll do that here in a second just to show you how all this kind of works together. But for this particular iteration, we're going to look at just using debt as the plug number. And so we're going to reduce debt by $162.22. You can see here that I've used Excel and linked to that external financing needed cell. And I've just changed the debt from 2000 that we started 2017 with, or I should say ended 2017 with. And we're going to reduce that by $162, which is the same thing as paying down debt by $162. So that's one possibility to make our balance sheet balance. Let's look at another possibility. Let's leave this as the 2000, and instead let's make our equity go down by the $162.22. So again, that's balancing. We've got $5,400 in liabilities and equity, $5,400 in assets. But what we've done here, we've increased our equity by $800, and we're returning $162 to the shareholders via a dividend. So what's happening here? Well, we've really changed this number to, oh dear, we've made this $162.22 bigger. That's reduced our retained earnings to $800, and so that's what's happening in this final version. We've really not paid a 30% dividend. We've paid a bit more, and we could figure out exactly what percentage that is if we're interested. Let's just see. If we divide that by this, our payout ratio, instead of being 32%, it's going to be 41.8% payout ratio. Would make everything balance. So I've showed you two different things we could do here. We could reduce the debt, or we could reduce the equity. I'm going to go back to where we were initially and have the debt being paid off to get us to a balance sheet. And now which one of those two things we do, and kind of what mix that the firm does, either paying down debt or paying down equity, or in the instance up here when we had a positive number, we had a gap we had to fill in. The choice of debt or equity is a function of the capital structure decisions of the firm, and we're going to be looking at that in much more detail later on in the course. So right now we're just going to take it as a given. You'll be given instructions either to use debt as a plug, use equity as a plug, or actually we're going to look later on at maintaining a debt to equity ratio, and what does that imply as to how we mix the debt and equity that we need. or how do we mix the debt and equity that we're returning to shareholders. So that is looking at a surplus and what we might do. So let's go ahead and go back to the PowerPoint here and move on to our next example here, where we examine excess capacity. And actually, instead of starting this video, and this is going to take a little bit more time, and it will turn into a long video, I'm going to go ahead and stop this one short. It'll be a little bit shorter than normal, but we've already taken a crack at one important little example, and we'll pick up with excess capacity in the next video.